Hi guys, and welcome back to Ask Rhyce, where I answer your questions about real estate. It's been a little while, but today's question was just around how to assess investment properties. I thought it was a really good one, a good one to touch on no matter what market you're in, no matter where you're looking, and yeah, hopefully this can help you out and give you a bit of guidance if you are considering purchasing an investment property. The first thing where I would start is once you've sort of narrowed down what you're looking at, look at what the outgoings are for the property. So outgoings, if you haven't purchased a property before or you don't own a property, are things to consider in terms of council rates, what your water is, any management fees for the property, body corporate fees. So if it's part of a strata titled property, so like a duplex or a unit complex, you'll have body corporate management fees. Any other outgoings that are costs that you need to be aware of or factor into your finances, week to week, month to month, annually, whatever it happens to be. So that could be fees associated with your mortgage. So outgoings. Get a really clear picture of what your outgoings are. Try and culminate them together, so you've got a total of, okay, look, per annum, this is what I'm looking at. It's going to help you come tax time for your accountant, but to me, it's a really good place to start. The next one, so you've got outgoings, obviously income. Income's really important, but when you're looking at income is not just as simple as, hey, look, the property rents for $300 a week, $500 a week. I would also be looking at, okay, what can affect your income? If you're looking at an investment property and it doesn't have a tenant in it, so it's vacant, that could be something you need to factor in. Okay, well, what's the how soon can I get someone in there paying me rent? If a property has an existing tenant, does the existing tenant want to stay? And if they do, that's fantastic. You know, then it's not an unknown. You know, okay, look, I can guarantee, or I know that I've got a tenant locked in at X rate, 300, 500, 200, whatever it happens to be, per week for the next for the term of their lease, and unless they were to break a lease or something like that, you can guarantee on that rent coming in week on week. If the property is vacant, another thing to consider, or even if you got a tenant, it's really important to get a clear idea of what the vacancy rates are for rentals in the area that you're looking at. So vacancy rates is just how many properties at any given time are available to rent. Now, what that gives you a good understanding of is that no matter the market, depending on what the vacancies are, that's going to tell you how long properties are sitting vacant or what sort of competition you've got. Now, that's going to have an impact on the rent return you'll be able to get. Typically, lower the vacancy rates, the better returns that we see. But more importantly, the biggest killer in investment properties, or in terms of the biggest killer in income on investment properties, is having your property vacant. The longer you have someone or have no one in there paying you a weekly steady income, it doesn't take very long for that to have a big impact on your annual income. So rental vacancy, another really important one. The other thing I would look at or think about or try and get a figure around, or try and put some sort of tangible to it, or if there is something there that you can do something with, is opportunities around rent. Now, opportunities around rent could be, could we get a better return if the property was furnished? Is there a better option in terms of, could we get more money if this was a short-term accommodation? So typically, we'll see leases that are 6 or 12 months long, but are you in a market where, hey, look, income-wise, is there an opportunity there for short-term accommodation? Lots of people talk about Airbnb. It doesn't necessarily have to be that, but short-term accommodation could be another way to improve your annual income of your property. The other, more traditional way, and typically we'd see this not just, but typically we'd see student accommodation, is rent per room. it's common, obviously, for students, as the example, to just sign on a total lease over a property. But is your property applicable to being rented by the room? Some properties are. Some properties are set up that way, and you can get a better return, or you possibly could get a better return doing that if that's an opportunity for your particular property you're looking at. Another one could be maintenance or services. Maintenance could be something like having lawns mowed. Maybe you can package that in as an add-on for your tenants, add a little bit of a premium on there in terms of it costs you $40 a week for the rent. Maybe you can, maybe that helps you increase your rent $50 a week. Who knows? Just to make it convenient. That could just be something that's a simple value add. Services could be obviously mowing, could be cleaning services. You just never know. Obviously, especially with the shorter term accommodation, but it could be an opportunity there for you. Finally, so you've got your outgoings, your income, get a really clear picture around both of those. Other things to consider are know the risks. Know the risks of what if my property gets damaged? Do I have landlord insurance? What if my tenants break their lease? What's the ins and outs of getting a new tenant or getting your property re-let in a timely fashion? What are the risks associated with the area that I live in? Have I purchased, the area that the property is in? Have I purchased in a volatile area? It could be, say it's resource related, so it could be, like a mining town. Is that something? Is that a risk? Risks doesn't necessarily mean could be bad, but you need to be aware of of all encompassing what you're getting into in terms of your investment property. Have a clear picture so that you make better decisions from the start before you've purchased it. It's best to enter into it with as much knowledge as you possibly can, rather than getting surprises down the track. The other one that I would say is know your strategy. Is it a long-term or a short-term strategy? They're very different. My personal belief is that the value in property is long-term. So, if you purchase something today, in 20 years' time, it's going to be worth considerably more than it is today. It will have brought you in income annually over that 20-year period. Ideally, it's paying for itself. It's as passive or a passive income source. That's a long-term strategy. Short-term is maybe buying something and giving it a bit of a birthday, doing a block renovation, new kitchen, bathrooms, carpets, floor coverings. You could go as far with that as you want or as little as you want. Maybe you're just doing paint, floor coverings and some light fittings, and then on selling the property. So is it a short or a long-term investment strategy? It's best to be very clear as to what you're entering into. Obviously that can change. But if you enter into it with a clear idea, okay, it's a long-term strategy, we're going to buy it, we're going to hold it for minimum next 10 years, then that's going to affect how you assess the properties and I guess the type of property that you're going to buy. But it's just really important to have a clear picture of that before you enter into purchasing something. What else? Probably the main ones for me to finish off would be, how does this sit with your current income and general financial planning? So whether that's talking financial planner or your tax agent or whoever it happens to be, how does the investment property sit into that? It pays to have that conversation with those people ahead of time. So maybe talk to your accountant and say, hey, look, I'm looking at investment property. I think it's a good thing for myself. How does that work in relation to my tax from my job, my income tax? Is this a positive thing? Is there anything I need to know, or what information will you need to know as my tax agent or moving forward? So I think it's really important to have those discussions ahead of time as well. And finally, my best piece of advice whenever you're assessing assessing an investment property or considering purchasing investment property is, and I think this is sound advice, whether it's houses or no matter what it is, if you're investing in fine art, know what you're investing in. Invest in what you know. Meaning that if you know a location particularly well, so recently a good friend of mine, they spent a lot of time in Perth, WA. Now that's way outside of my knowledge base. I've never done anything in terms of property over there. But talking to him, it's clear that he knows the area. There's different things in there, school catchments, etc., that affect it and make it a desirable area, the particular suburb he was talking to me about. All of that's really important. If you're investing in what you know, you're able to make a better decision. So I always say, invest in what you know. That's where I guess better decisions come from, I suppose, is the best way to look at it. Even today, just talking to a lady this afternoon who's looking at investing in a unit locally. She's actually renting a unit a couple of doors down in another duplex. But she really knows, she likes the area, she knows it. She doesn't know the broader area, but she's like, you know what, I like this location. And when I first decided to rent here, I did a lot of research and I decided that this is where I wanted to be. And so equally, the potential of buying an investment property in that area is really appealing. So invest in what you know. So to recap, outgoings, get a really clear picture of what it costs to keep that property. Over an annual basis. Income, exact same thing. Look at what your income is, any risks associated to that income being interrupted, and any opportunities to increase it or value add, or maybe get a little bit more than what the property is currently getting or what it's currently appraised to get. And then other considerations, as I said, really is just make sure you know the risks. Make sure you're prepared for what's involved in being a landlord. Make sure you know your investment strategy, whether it's a long-term or a short-term strategy. I think that's really important. A lot of people, I think, aren't really sure. They're on the fence. They kind of neither short nor long, and then they don't have a clear vision of where they're going. So I think that's really important. And yeah, make sure you get some good advice. Talk to your tax specialist, your accountant. Talk to your financial planner. Sit down with them and work out, okay, how does this investment property fit in with the rest of my financial planning for the next 12 months, 10 years? And invest in what you know. Final thing, and I think probably the most important thing, invest in what you know. If you know units, invest in them. That's fantastic. If you know Queenslanders, so in Queensland here, you know, like timber, beautiful, colonial, whatever it happens to be, cottages, whatever, like a particular niche, if you know that really well, then invest in it. Like, if you know something well, you're going to see more than what others do. You're going to be able to assess the opportunities and get a real sense for the people that want those properties, whether, you know, it's a tenant or if you're wanting to on-sell it down the track. Investing in what you know, I think, is probably, above all else, probably the most important one. But anyway, guys, I really hope that helps. A little bit of a longer one today. It's been a while. If you have any questions whatsoever, please post them in the comments below, and I'll talk to you soon. Thanks.